This is National 401k Day, and if you, like me and so many others, have been frustrated watching the market roller coaster and wondering what's the best course of action, let's try and find some answers for all of us. Joining me on the morning show, Barnett, Managing Director for First Florida Investment Services and a certified financial planner. Good morning. Thanks for joining us.
Good morning. Happy Friday. Thanks for having me.
You too. So we know it's been a market ride, big time ride, and people are prone to knee-jerk reactions. Best advice still, we're in for this for the long haul. Hold on tight.
Absolutely. Yeah. So we need to look at our 401ks as an asset. So similar to any other asset we might have. What I like to tell people is if we look at our home as an asset, if it, for whatever reason, lost 25% of its value, doesn't mean we need to go pound a for sale sign in the yard. So we need to view these things as assets and avert our gaze away from the short term for sure.
So we have automatic deductions being taken from our paychecks. Stay the course on that. But what about adjusting our investment portfolios?
Yeah, that should be done on a regular basis. Inside of many 401ks exist what are called target date retirement funds. And so they are designed to do just what you described there. So as we get older and our goals change, those assets become less risky, that sort of thing. But certainly it does pay to seek out the objectives of each fund that you're in and talk to the professional that's associated with your plan for that guidance.
You know, I know some people say, I think I want to withdraw my money from my 401k to shelter it from what's going on right now. That could cause you to pay some substantial penalties because it's not like a regular investment account.
That's absolutely and so well said. 401k, if we withdraw funds prior to 59 and a half, in most cases, not only will we pay tax on it if it's funded by pre-tax money, but then there will be an excise tax of 10%. So at some point prior to retirement age, it's very expensive money to withdraw.
So how do you best assess where your nest egg should be and take into account that nasty word we keep hearing so much about these days, inflation?
Yeah. Well, I think it's good to have a couple benchmarks just to kind of keep in mind. Objectives and benchmarks and goals, that's really what these long-term things are all about. Your deferral rate is the biggest thing. So if we can target a deferral rate of around 15%, including your match for your employers, some employers will match up to 5%. That's a good target to have. And people ask me, how much money should I have saved? Well, just think of it this way. By the time you retire, if you can have saved about 10 times what your final salary is, actuarially, it's going to work out for you. So there's some rules of thumb, good ways to think of some good goals.
How about if you're a little bit behind? Ways to get back on track?
Yeah, again, that's so important. Life does what life does. Younger, when we have kids, things like that, save as well. Well, the IRS gives us what are called catch-up contributions, which once we're past the age of 50, we could defer inside of a 401k up to $20,500 prior to 50, but up to $28,000 after the age 50. So they call those catch-up contributions important to pay attention to if you've missed out.
I remember when I was a kid and 401ks first came out, I was like, oh my gosh, 65 is a long way off. I don't have to start saving now. That ain't the way to think.
No, it's really.
Okay, he froze up there, but I'm telling you, Christian would tell you, it's not the way to think because it sneaks up on you. The sooner you start saving, the more the money starts compounding, the better off you're going to be, the earlier you can retire and enjoy your life, maybe travel and do whatever you dreamed.